Welcome to the Small Axe Podcast. It's your boy Nico, the multifamily family man. We are going to talk about everything regarding multifamily real estate investing. Stick with me. This podcast episode is going to be epic. What is up, party people united? Welcome back to another episode of the Small Axe Podcast. Today, I want to answer a question that I've been thinking about a lot lately, and I'm sure you have been thinking about it as well. Is this the time to buy multifamily? Because we've been hearing the same story for like 3 years now. Interest rates went up. Property values were going to come down. Loans were going to mature. Owners were going to get crushed on refinances. Distress is coming. Blood in the streets. Sellers are going to have to accept reality. And then all of those incredible buying opportunities were supposedly going to appear. Poof, they're here. Buy everything. You're going to buy it at half price. Well, where are they? Where are those deals? Because we are well into 2026 right now, and I'm still not seeing this massive wave of distressed multifamily deals that everybody told us was coming. There are deals out there. There are definitely owners struggling. There are properties that don't make sense at their current debt, but we're not necessarily seeing apartment buildings being given away. So I wanted to look at some data today and try to answer a different question. Not, has multifamily hit the bottom? Because I don't know. Nobody knows. And if they say they know, they're lying. Nobody really knows. The question that I think is a little bit more useful today is, if I were a newer investor sitting on $100,000 today, and I wanted to get involved in multifamily, would I buy right now or would I keep waiting? And that's what I want to dig into today. First, where are all the deals? We're going to start with transaction volume because this tells us something really interesting. According to Yardi Matrix, only about 26.6 billion of multifamily traded during the first 5 months of 2026. That's actually down 11% from the same period last year. CBRE saw something similar in the first quarter. Multifamily investment volume was about 29.5 billion, down 6% year over year. So, despite everything we've heard about the market thawing out, there still aren't that many buildings that are changing hand. And it's definitely not because investors don't have money. In fact, the data shows roughly 174 billion of capital that had been raised over a 2-year period for U.S. multifamily acquisitions. So think about that for a second. That is a huge amount of money looking for deals. But the deals aren't closing. Why? And I think a big part of that answer is actually easier than we would imagine. So buyers and sellers still don't agree on what the buildings are worth. That is important. Sellers want high, buyers want low, always, right? The buyer is saying that interest rates are higher, insurance is higher, my debt service is higher, rent growth is basically non-existent, right? In many markets, I need a better price. And the seller is saying, I know what the building was worth in 21 or 22, and I'm not selling it for 25% less than that. So they just sit and nothing moves, nothing happens. That's the bid-ask spread that everybody keeps talking about, but eventually something has to give. The price of multifamily has definitely already changed. I see it, and if you don't see it, you got to look harder. Let's talk about it for a second. The Real Page reported that the average cap rate on apartment transactions in the first quarter of 2026 was about 5.75%. Compare that with the second quarter of 2022, when the average cap rate was 4.64. That is a huge difference, a huge change. And I think newer investors need to understand what that means. A cap rate isn't just some number that brokers throw around. It directly affects value. We're going to do some quick, simple math for you. Say a building that you own has $100,000 of NOI. At a 4.6% cap rate, that is roughly worth $2.17 million. Take the exact same 100,000 NOI and value it at a 5.75% cap rate. Now it's only worth 1.74 million. Same building, same tenants, same NOI, more than a $400,000 difference in value. So That's what changing the cap rate does to valuation. And this is one of the reasons that owners don't want to sell. Because if they bought or refinanced when cap rates were incredibly low, today's valuation can be painful. But here's where it gets interesting for buyers like you and me. You are no longer necessarily paying yesterday's prices. And if you're a long-term investor, that starts getting my attention for sure. But don't confuse a lower price with a good deal. Of course, we have to do our work. We have to do our due diligence, our own pro forma, our own underwriting. And this is where I need to slow down because it's important for newer investors, including myself. Just because a building used to be worth 2 million and somebody will sell it to you for 1.7 doesn't mean that you're still getting a good deal. It might sound like it at face value, but it's not necessarily a good deal. Maybe it was never worth that 2 million. Maybe the rents were inflated. Maybe expenses were understated. Maybe insurance doubled in that time. Perhaps taxes reset after that sale. Maybe the building needs $300,000 of work because there's a CapEx tsunami happening. Maybe the tenants aren't actually paying their rent. So just remember that a discount on an inflated, stupid, silly price is still a stupid price. So don't get caught up in the property was listed for 3 million last year and now they'll take 2.4 million. Who cares? What does the property produce today? That's what matters. Can you make it cash flow today under your pro forma? How you know you can operate? Will it cash flow? Will you be able to stash cash in times of more trouble, more pain, which could potentially happen? What debt can I get today? What's my debt service? How much cash do I need to put into it? What fixes need to be done? How much cash do I need to keep in reserves? Can I stack those reserves with cash flow monthly? And what return am I going to get in the end based on what the property is actually doing today? Those are the questions you need to ask. Now, let's pivot a little bit and talk about distress, because there absolutely is distress today in commercial real estate. TREP's July numbers show the overall CMBS delinquency rate jumped 7.86%, and multifamily CMBS delinquency reached 7.69% in July, up 46 basis points in 1 month. Now, before anybody runs out and says almost 8% of apartment buildings are delinquent, that's not what the number actually means, so chill, bro. This is specifically for CMBS debt. It's one segment of the multifamily lending universe. That's an important distinction because multifamily is financed through banks, Fannie Mae, Freddie Mac, life companies, private lenders, and a whole bunch of other sources. Yes. And in fact, the Mortgage Bankers Association reported that commercial mortgage delinquency rates actually declined across major property types and capital sources during the second quarter. So the picture is mixed. There is stress, but it isn't 2008. We're not seeing every lender taking back buildings and dumping them onto the market. What we're seeing are individual owners who are getting squeezed. And that is where I think smaller investors should pay attention, because being squeezed just means you have to work a little bit harder. It doesn't mean that you're going to give up the property to foreclosure. Now, if you are in that case or that scenario where you might be potentially losing the property, you can always negotiate with the bank for perhaps an extension, maybe a loan modification, something to help you out to continue operating past this time of distress and challenge. You might make it to the other side, or you might have to dump the property for a loss, but that's a different situation than what I'm talking about here. And we're not necessarily even hitting foreclosure at this point. We're just talking about how to deal with what the stressors are today. So the opportunity might not look like a foreclosure for you. Okay. Everybody's waiting for some giant red sign saying distressed multifamily, 40% off. Everybody's foreclosing. You can snag a deal. That's probably not how your opportunity is going to show up, especially if you're trying to buy a 6-unit, 10-unit, 12-unit, maybe even a 20-unit property. Your opportunity might be a guy who bought the building 7 years ago and is just tired. Maybe his loan is maturing. Maybe he doesn't want to put another $100,000 into the property. Maybe he's dealing with vacancies. Maybe his insurance has gone crazy. Maybe his partner just wants out. Maybe he's 68 years old and doesn't want to deal with tenants anymore. Maybe he's trying to sell at 1.8 million for a year, and suddenly he'll entertain 1.5 million. So that is also a form of distress. Not necessarily everybody foreclosing and blood on the streets, but that, what I just stated, is also a form of distress. And it's not necessarily going to show up in a national distress statistic making headlines across newspapers. But this is also an indicator that relationships and being involved in the game are going to matter. You have to be constantly talking with brokers, sellers, property managers that are close to this, that see this happening. Talk to the local lenders. Ask brokers which listings have been sitting for so long, which deals have fallen out of contract. That's big. Which sellers have debt coming due and are more likely to sell potentially at a discount today. The maturity problem is certainly happening right now. I am in the midst of this too. I have a loan coming due. My first loan is going to be coming due in October of 2027. So that's an issue. Am I going to sell prior? Am I going to refinance? Am I going to request an extension? That's debt maturity. It's a real thing. So TRIP identified about 76 billion or so of CMBS hard maturities in 2026 alone. And roughly 39% of those maturities are concentrated in the fourth quarter. So yeah, something's happening. And again, that's across commercial real estate, not just multifamily, but it's important and significant in its own right. But multifamily is one of the property types with meaningful refinancing exposure for sure. And here's why that maturity matters. Imagine somebody bought a building several years ago with cheap debt. Maybe their rate was 3.5%, maybe 4%. I don't know. Their loan matures. Now they go to refinance, and the new loan is not 3.5%. It is more like 6.5%. A big difference, maybe more even, depending on the property and the borrower. Now the lender looks at the property and says, okay, your NOI doesn't support the loan balance that you currently have. And this is where things start getting uncomfortable. You can't support the 1.25 debt service coverage ratio that they need. So instead of doing a cash out refinance, some owners may have to put money into the deal just to refinance, a cash in refinance. And many owners cannot do that. That's where opportunities start appearing, not necessarily because the property failed, literally because the capital structure failed. It's a huge distinction. You might have a perfectly good apartment building, good location, good tenants, good occupancy, but the owner put too much debt on it when it was cheap. And now you can't afford a refinance, or you're underwater if you're going to refinance. That is a huge distinction. So should you wait for interest rates to come down? This is probably the question that I hear more than anything. Should I just wait? Will interest rates come down? Who knows, guys? Maybe. We have Kevin Warsh in power now, who said he was going to try to bring rates down, but the data is not necessarily supporting decreasing our interest rates today. And the Fed is divided. So chill out. We can't predict the future. Rates may come down, but there's a problem with this strategy of expecting and waiting for rates to come down. Remember what I said before, there is a lot of capital sitting on the sidelines. And if debt becomes significantly cheaper, buyers can pay more. And if buyers can pay more, what happens? Prices go up. Cap rates can compress again. Competition increases. Everybody's all of a sudden back in the game. Suddenly, the property that didn't work for you at 1.5 million today might have cheaper financing a year from now. But then the seller's going to want 1.7 million. So I am not trying to time the interest rates. I would rather buy at a good deal at today's rate and have the possibility of refinancing into something better later. I just want you to fix that rate for 5 years. That's all I ask. Fix the rate that works today for 5 years. The deal has to work at today's rate. Okay, so let's talk about it again. My original question. I've got $100,000. I want to buy my first multifamily property. Would I buy today? Yes. But I would not be in a rush today, and I wouldn't do anything crazy. There are two different things happening. I would absolutely be looking. I would definitely be underwriting deals, talking to brokers, building relationships with local lenders, touring properties, making offers. But my goal would not be, I need to buy something in the next 6 months. My goal instead would be, I want to be ready when the right situation shows up. So I need to be dialed in, seeing everything that's online, how things are trading. Because the environment we're in right now gives buyers something we didn't have much of a few years ago, and that's time. When I first started really buying multifamily, there were times when you'd get an offering memorandum and there were 15 or 20 buyers looking at the same thing. Prices went up. and bidding was over asking price, best and final, get your offer in. Come on, no financing contingency, hard money day one, go, go, go. That is a very difficult environment for a newer investor, and I struggled significantly with it, and I played the game, and I won, and I lost. You may find a building that's been sitting for 6 months. That's an opportunity to ask questions. Why hasn't it sold? What's wrong with it? What does the seller actually want or need? Is price the only issue? Maybe they can sell or finance a deal. Maybe they can carry a second note on the property. Maybe they'll give you a credit. Maybe they will extend your due diligence period. Maybe you can assume the existing debt. Maybe the solution isn't simply offering more money, and that is where a smaller investor can get creative. Here's how I would underwrite it. If I'm buying today, I'm starting with actual trailing operations, not the broker's nonsense. Give me that T12. Give me today's rent roll. Give me the bank statements if I can get my hands on them prior to due diligence. Give me utility bills, insurance, tax, delinquency. Show me some bad debt. Show me the vacancy, historical vacancy. Show me the repairs that have been done. Then I'm going to normalize those numbers. I'm going to create my own pro forma with flat rents, lock in today's rate for 5 years, and see if I can get this property to perform well under how I know how to operate. And after last week's episode, you already know how I feel about rent growth. I'm not getting into a deal that requires 3%, 5% rent growth year over year. It's just not going to happen. I want to know, does it work today? If rents do not move for 2 years, if they're flat, then I'm looking at debt coverage. Is the property barely able to cover the mortgage with very little money left over? I don't want that deal. I need cushion because stuff will happen for sure. A roof goes, a leak happens, insurance increases, 3 tenants leave at the same time, a sewer line breaks. Guys, this happens to me weekly. You have no idea. The property manager screws something up. You find out electrical panels need to be replaced. Guys, real estate is messy. So your spreadsheet needs room for real life. Don't be so uptight or tight or perfect on your spreadsheet. Please understand that you will encounter challenges and be prepared for those challenges. And please keep some cash on hand. This might be the least exciting advice that I can possibly give you today. Don't put every dollar that you have into the acquisition. If you have $100,000 and buying the property requires $99,000, you can't really afford that property. I want reserves, real reserves, not a credit card that I'm calling a reserve. I need cash reserves on hand for every property that I own. Absolutely no questions asked. Because when something goes wrong, and something eventually absolutely will go wrong, I don't want to be forced into making a terrible decision that I have no liquidity and now I need to tap into some crazy credit card or some weird personal loan or something. Maybe that means that just buy a smaller property. Fine. Maybe it means passing or bringing in a partner. Fine. Maybe it means waiting another 6 months. Fine. Surviving today is more important than maximizing your leverage and cashing out everything you have and own for something that you are hoping and wishing will perform well. And on that note, I would like to talk about what would make me walk away today. And obviously, there's always something that's going to scare me. But today, a few things that would scare me from a deal pretty quickly would be aggressive rent growth necessary. I am out. If the seller can't prove the income that they have, I am nervous. If the insurance quote blows up my NOI and I'm already in due diligence, I might walk. If the lender's giving me the absolute maximum leverage and the property barely covers the debt, I am probably going to reduce leverage or just walk. If there's a massive deferred maintenance and I don't have enough cash left over after closing to handle it, I am definitely out. And if I find myself changing assumptions in my spreadsheet just to make the deal work, that is usually my sign. I am pencil whipping the deal. We have all done it. You're looking at a deal that you really want, and you change vacancy from 8% to 5%. You bump rent growth a little bit. You lower repairs. Maybe you move your exit cap rate down just a touch to make it look better. And look at that. Now it's an 18% IRR. Okay, guys, that is not underwriting. That is negotiating with yourself. Don't do it. In multifamily real estate, we cannot be emotional. This is not your personal residence. This is not where you're raising your family. This is where you're going to get income to support your family, and your future. After everything I just said, I actually think this could become a really interesting period for some smaller multifamily investors, and here's why. We're starting to see pieces of the market moving in the right direction for buyers. Cap rates are significantly higher than their 2022 lows. Transaction volume is still depressed. Some owners are dealing with difficult refinances, myself included. CMBS multifamily distress has increased. The construction pipeline is finally beginning to slow down. Yardi expects about 478,000 multifamily completions in 2026, almost 25% fewer than 2025. And the under construction pipeline has been declining since March of 2024. So think about the potential setup. You're buying after cap rates have expanded. You're buying while transaction volume is still weak. You're potentially negotiating with an owner who has a maturity or capital problem. You're buying as future supply growth begins slowing. Does that guarantee that you're buying at the bottom? Hell no. But do I like that setup more than buying at a 4% cap rate with 3% debt and assuming rents are going to grow at 8% forever? Yes, I do. A lot more. You don't need to call the bottom. That's the biggest message that I want to leave you with today. Stop trying to call the bottom. You don't need to. Think about people who built tremendous wealth buying real estate after the financial crisis. Did every one of those people buy on the exact day the market bottomed? Of course not. They bought good assets at prices that made sense to them, and they held them. That's what I'm looking for. I'm not trying to buy multifamily on the cheapest day of the decade. I'm trying to buy a good building at a basis that makes sense with debt I can comfortably service, enough cash reserves in the bank to survive problems, and enough upside that I can create value through operations. If I get all of that and prices fall another 5% next year, okay, I'm not selling next year. But if I'm right over 10 years, that's what matters. So is the buying opportunity finally here? Yeah, kind of. I don't think the floodgates have opened. I don't think there's some giant multifamily crash happening where you can buy apartment buildings for 50 cents on the dollar. And the data doesn't support that story either. But I do think that the environment is becoming more interesting for people like you and me. We're seeing pressure for sure. We're seeing maturities, and that matters for sure. We're starting to see sellers who've been sitting on the sidelines for years. We're seeing higher cap rates. We're seeing slower construction, and we're seeing buyers who are finally able to negotiate again. No more hard money. And this is an opportunity, especially for you and me, because you don't need 10,000 distressed apartment buildings. You need one. You need one tired owner, one bad partnership, one loan maturity, one property that's poorly managed, one broker that calls you with a pocket listing before it hits market, one seller who's finally ready to be reasonable. That's it. So if you're trying to buy your first multifamily property, don't spend the next 2 years sitting on the sidelines waiting for CNBC to announce that we've officially hit the bottom. Start building relationships today. Start underwriting right now. Tour buildings, talk to lenders, make offers, learn your market, know exactly what you will and won't buy, and keep your powder dry. Because the one opportunity that does show up, you want to recognize it and you want to be able to jump on it right away. You want to be able to close. So if you got some value out of today's episode, I would love it if you were to subscribe, leave a rating and review. If you were to go to my Stan store, stan.store/buy buildings, you can find so many free and paid resources there. If you're looking to learn more about multifamily, I have an 8-module course called Buy Buildings, Build Empires. Check it out. It is insanely affordable compared to all the competitors out there. I try to give you guys everything I can with my small axe. And I know a lot of you are working with a small axe as well. So go to my Stan store right now, stan.store/buy buildings. Find something that's right for you. Share this episode with somebody that you think could get value. And I will see you guys on that next episode. Keep swinging your small axes. Thank you so much for joining me today on the Small Axe Podcast. Your attention truly means the world to me. Please leave a rating and write a review. Also, share this episode with somebody that you think could get value from it. Remember, it only takes a small act to build a lasting empire. So get out there and start building your own.